Ladies and gentlemen, welcome back to the channel. What a volatile day here in the S&P 500 and the overall markets. It has been nothing short of mind fuckery, if that's the word you want to put for it. Hopefully you guys are using this volatility to make some money nonetheless. We're starting to try for this end of the day rally comeback. We'll see if that happens. Yesterday's 10-minute rigged, the move on 350, the last 10 minutes of trading was a 1% positive move to the upside. So we will see exactly how this thing hashes out by the end of the day today, but it certainly looks better than not right now. But I will point out to you guys, this is now the second time that we have come down to 405. We have hit a bottom and since retraced dramatically. Right? Last time this happened was actually back here. We'll go ahead and pull this up. And that was on May 2nd. Came down 405.02. Retraced straight up. End of the day. This was a very historical rally. And then we had the Fed meeting, another historical rally. And then the next day, obviously yesterday was a very bad day. Now, in all reality, we have moved around a lot, but we have not moved at all. We are still at the levels we were for the last week. We really have not done all too much. Now, I do think in the grand scope of things, we are actually getting very, very close to a bottom. As you can see from some of these technical indicators, like the MACD, extremely bearish. The RSI, extremely bearish. And if we do go ahead and pull up the Bollinger Bands, you always tend to come back to the Bollinger Bands in due time. And the Bollinger Band, the 20-day simple moving average, is at 429. So I do think a rally of that magnitude is definitely in store for us potentially next week. And I want to go over exactly what is going to cause that rally next week if it does indeed happen. And it's going to be the CPI report. And we have some news and data we need to go over for today as well. But the next CPI report comes out May 11th. That is Wednesday, 8:30 a.m. in the morning. If core CPI comes down again for the third straight report, I personally believe you are going to see a rally in the markets. Now, it may or may not happen. Obviously, I am not a fortune teller here, but that's really going to be something that is materially bullish for the markets. The markets right now have a lot of uncertainties. The COVID lockdowns in China, the Federal Reserve, and what they said is actually reducing a lot of the uncertainties. They threw away the odds of a 75 basis point rate hike. They told us, hey, we're going to start balance sheet reduction about $40 billion June 1st, and then we're going to ramp that up to about $95 billion, what we had initially expected by September. So that's actually a lot of uncertainty that is taken out of the air, and the next Fed meeting coming in early June, literally about 1 month from now, is not going to be as big of a catalyst because we already know what to expect. And like I said, a lot of the uncertainties are actually out of the way. So depending how CPI goes, that's going to be potentially a very bullish catalyst. I think the overall sentiment for inflation and the inflation report right now is definitely not good. So I think there's a lot more room to upset to the upside and have the markets go up off of that comparatively to actually coming down. So that's going to be the next big potential bullish or bearish catalyst that we have for the markets. And it's coming next week, so there's a lot. Now, we do have earnings season out of the way, so you have that uncertainty that is also gone. You got the reports from all the largest companies in America that move the American stock market, and by and large they were pretty good. So the fundamentals are still intact for a lot of these core businesses, right? The trillion-dollar companies that have 5 to 7% weightings, depending if you're a Microsoft at a 5% weighting or an Apple at a 7% market weighting. You've gotten those earnings out of the way, so it's not like we're expecting brand new numbers and we're going to react very harshly to that. That's not the case. Now, these intraday moves really come down to the margin call situation that is developing. Every single day that we are just flushing down to 405, coming back up, coming back down, going back up over the last week or so, it really has to do with the margin calls. And what exactly do I mean by margin calls? A lot of people will say, hey, how do you know there's margin calls? Well, you can pull up the Google Trends data and it's very easy to see. We are at the highest level of margin call searches for Google since the movie Margin Call came out in 2011. So it's pretty straightforward to see in that realm. The data is there. I will tell you, if everything sells off like we seen yesterday, 6% we come down and test the yearly low again today, that is margin calls. And historically, when the bond market is down 3% in a day, like it is, well, it was yesterday. Now it's down 1.6%, meaning people are flooding out of bonds and interest rates are going up. Now, TLT was down 3% yesterday. The S&P was down 3% yesterday. That, historically speaking, is when you tend to see the bottom. When you see massive sell-offs, you see bonds selling off, stocks selling off, literally everything selling off, all asset classes. Besides real estate right now, selling off like that, you are closer to a bottom than not. Now, I'm not saying this is a yearly bottom that we could not go lower. I'm obviously not very bullish throughout the rest of the year, but I do think this sudden pullback in the markets over 25%, you will see a nice relief rally on the slightest bit of fundamental positive news. Now, what do I mean fundamental positive news? That could potentially mean the war in Ukraine ending, because that would affect CPI. That would help, obviously, inflationary pressures, and just that happening, regardless of like sanctions are lifted or not, that would take a lot of, of the negative air out of the markets, and potentially you could see a big relief rally based off of that. COVID's lockdowns in China going away, that's obviously going to be a great thing. Obviously, CPI going down, also another big thing. So I don't think it's going to take a lot of, those potential fundamental bullish things for the markets to actually cause the markets to react very violently. Keep in mind, we have a 2-to-1 put to call ratio. So for every one call you place on the markets, there is pretty much 2 other puts being placed on the markets. And these hedge funds and institutions, to hedge out their portfolios, they don't want to see a 5 or 10% drop in the markets to actually properly hedge out their portfolios. So what they do is they spend a lot of money. These are options that you guys really don't have the opportunities to touch, especially on the S&P. They could be $30,000, $50,000 options, but what they do is they buy those options with a very low break even. So even on days like today, if you headed into today, when the SPY was at 414, right? Well, what was it at? Like 411. Yesterday was like a 412 close, somewhere around there, give or take. If you came into that with a 0.5% break even, but yet the markets dropped 2% right off the start, the market makers had to go out and short a shit ton of stocks to oblige for those options. And then what do when the markets start to bounce? You de-risk. You take those shorts off. And it's like a ping-ponging game back and forth. That's the best way to put it right now. And what does that ultimately mean? That when a lot of those puts get de-hedged, when there's a fundamental change to the markets will rally in a very, very dramatic way. Now, I don't know when that will be. I'm only throwing out guesses here. Those are some catalysts that could cause this. But historically as well, when everybody is bearish, that is usually when you tend to see a large market bounce. Now, let's talk about AMC and exactly what is going on today. And overall, this market sell-off is led by the bonds. If you go ahead and look at the bond rates today, they're absolutely terrible at 3.11%. This looks like a damn momentum stock. So surprisingly, if you're in stocks, you're actually doing a little bit better than somebody that was in bonds in 2022, because bonds have sold off a lot more than stocks have, and it's not a pretty picture for the bond market, for the stock market, everything. And if you're thinking about a potential rally in certain stocks, to see liquidity drop like that and short interest being 30%, 20%, 40% within certain companies, that's where you can really see these colossal rallies once fundamental changes happen in the markets. And that's going to be the biggest thing that I am actually paying attention to. But if we do go ahead and pull up some of the news that did come out, we did get the jobs report. And let's just go ahead and Google the damn jobs report, because it wasn't on the main CNBC headline. But that's all right. That's all right. We'll pull it up. No big deal. Here we go. It says, explainer, more pressure on the Fed from April jobs report. And it does go on to say that we created about 430,000 new jobs, 428,000 new jobs to be precise there. So there's obviously a reason for the markets to sell off right there. And that's exactly what happened today. Even though we are starting to bounce back and we'll see exactly what happens, that's a big reason for the markets to sell off. And that means everything is going to sell off. Some things more than not. You know, some things are going to do better, some things are going to do worse, but it's a big reason to see bond rates going up, right? And to see the stock market going down, because after all, if you have a tight labor market like we do right now, you know, the Fed's hand is being forced to be even more aggressive, even if inflation does start to come down. Like, we have got 2 back-to-back core CPI readings that have fallen, right? So it's actually looking really good. So if next week on Wednesday, the CPI report, the core CPI comes down, that's going to be the 3rd declining core CPI reading that we have seen. Core CPI, again, minus food and energy. All right, but now that we went over potentially the bullish thesis for next week, I kind of want to talk about what is happening today. And if you don't know, now you do know. SOFI stock is down 5.71%, down 0.31% here in after hours. But why is that? Because after all, like I said earlier, we have a lot of uncertainties that are off the table. We know what the Fed is going to do. Well, the bond market is kind of calling the Fed's bluff. The bond market hit a new multi-year low today. Like, I don't know how far you actually have to go back to see a low this low. You actually have to go back to 2018 when TLT was at 105.69, and the bond yields look like a damn momentum stock. So that's why I say Fed and fintech, because Fed and fintech go hand in hand. If the markets perceive the Fed to raise super aggressively and push the economy into a recession, one, that's going to drive up the borrowing rates, which will kill demand. A term you guys need to know is demand destruction. You're going to hear that a lot over the next year. Essentially, when the Fed just raises rates so much or prices become unbearable, that you kill demand, and that's where demand destruction comes in. And when bonds move up this aggressively in a single day, TLT going down 1.5%, down 0.19% here in after hours, after already falling over 3% yesterday, seeing a full-on meltdown and a gap down, then you will expect to see SOFI stock heading down this dramatically in a day. Now, I do want you guys to pay attention to the correlation here, right? Take into consideration yesterday, we sold off pretty much all day, a terrible day, down over 6% on the NASDAQ at one point, and then we did start to recover towards the end of the day. That was fueled by the bond market. So the bond market is leading the stock market here, and that's why I say if CPI comes down again, or core CPI at least, for the 3rd straight report, the markets might start to take a breath here, right? And you can imagine it like this. People are selling off bonds, making the yields go up because people expect inflation to be much worse and last a lot longer than what the Fed is saying. Basically saying that the Fed is wrong about inflation, that the Fed is wrong about the economy, right? So people are going to sell bonds, because why would they want a 3.12% return for 10 years and then get paid out their principal amount back if essentially inflation is going to be 5% every year for the next 10 years? You would lose a lot of money on these bonds. So people sell off the bonds. Now, what happens when, that thesis starts to be proven wrong, which I do think it will be via the CPI reports obviously coming in lower? People will start to say, hey, maybe inflation will not last as long as we think. Maybe we should go ahead and buy some of those bonds back that we sold and get an even more attractive yield. This thing looks like a damn momentum stock right now. And that's what will drive the next market rally. I'm telling you right now, it's going to be a CPI report, or potentially the war in Ukraine ending, which would drive energy prices down, which would reduce the potential possibilities of seeing a very harsh recession. Because I believe it's for every $2 the price of oil goes up, it's like $2 billion less of money people can spend on consumer discretionary products, either when those two things happen or when the China COVID lockdown ends, which again will theoretically improve supply chains, and that would be another fundamental positive thing for the markets, then you will start to see bonds coming down, because eventually everything that goes up must come back down, and that could fuel the next potential rally here in the markets. And as you guys can see, this is just straight up. It's literally vertical. So eventually you will take a little bit of a breather like we've seen in 2018. Even if the bond rates could drop 1/3% in a given month, that could fuel a 5 to 10% rally in the markets. And that's kind of what I expect. I don't know if it'll start on Monday. I don't know if it'll start on Wednesday after the CPI report, but I know it will start soon, and I know it will start eventually. And some of the stocks that are going to be the biggest runners are going to be the ones that are the biggest losers right now, especially something like SOFI, just like we seen yesterday, right? Or 2 days ago, the Fed meeting. SOFI stock was up like 10% that day because the bonds took a relief. It took a slight chill pill, and these stocks can just rally. Now, in the case of SOFI, obviously the short interest is very, very high. So you're going to have that extra fuel on the fire to potentially drive the stock up massively. And as we can even see from the option activity, a lot of short-term bearish activity that is coming through for SOFI stock, with a lot of these break evens being pretty close to the money. So essentially what that means, if you went ahead and bought a put that has a break even of 1/4%, say if SOFI stock fell 1/4%, your put would now be in the money. Those are obviously expensive options. Those are the ones that hedge funds like to buy, because they don't want a 5 or 10 or 25% break even amount, which you can get paid out big percentage wise on some of those trades. But market makers, well, not market makers, but money managers, they don't want to do that because that's too much risk. If it goes against you, you're going to lose everything, right? You can make a lot, you could lose a lot. So what they like to do is just hedge out their portfolios. So they'll buy those puts that are close to the break-even price, and then essentially the market makers have to go out and short the stock even more. So it's like a double whammy of shorting pressure, besides even just the shorts that put on short positions. They just short regular stocks. So that's exactly what is going on here in the markets, and it has what has been going on for quite a long time. But eventually, when that attitude or when a fundamental change happens to the markets, everything will reverse course in a very short amount of time. Now, the option flow activity for the day was 6 orders totaling $1.6 million, positive order value of 1%. Yesterday, a 94% positive order value. So you can see the flip-flop here is quite dramatic. And the short interest of free flow is close to 20%, sitting at 19.78%. Current shares that are sold short of 143.96 million. Cost bar max of 3.54%. Utilization of 100%, and days to cover sitting at 3.91. So obviously the situation here looking good in the aspects of potentially when you do get that fundamental good news and the stock does start to actually rally. So that's going to be the keys. Overall, I do think we are closer to a bottom now than we have been in quite a while. SOFI stock, watch that $5 level if the instability in the markets does continue, and watch that $8.48 level to the upside if potentially we do get that fundamental good news. So that is going to be all for this video. You guys enjoy your weekend. We got a lot to talk about over the weekend as well, and I do want to let you guys in on some things that I have been looking at. So stay tuned for that. Enjoy your weekend. Happy Mother's Day, especially to all the mothers out there. I will see you in the next one.